What's going on, guys? Bryant's here. Today is Monday, September 13th, 2021, and the market is closed as I'm recording this. Now, it's been a while since I've done a dedicated strategy-based video, and the last time I did one last year, you guys really enjoyed it. So I figured I'd follow up with a timeless strategy on the S&P 500. You can use it on a lot of different tickers, but we're going to be focusing on the SPY today because the principles in this video has worked for a long time, and it should not stop working in any time in the future. So I'm going to make the assumption you already understand how to trade, as well as understanding principles like VWAP, which is the volume weighted average price, or you have some understanding of how to use the Fibonacci's whenever you're trading. So jumping right into it, what we have here is the SPY on the daily time frame, and we know this is 2021. We've been in a very strong uptrend. However, we're experiencing some sort of short temporary pullback, or if this is a crash, no one knows. But we're going to be talking about the trend right now that is down. So even though we're in an uptrend for day traders, this is mostly a day trading based strategy. We're in a current downtrend, and this is what you're going to want to be looking for. So if we take a look at the SPY, let's also take a look at the NASDAQ, because the tech sector is a heavily weighted sector in the S&P 500. So the same thing for this year. We've been in a very strong uptrend. However, we're experiencing a temporary downtrend. Now, swiping right over to my Discord, I do want to point this out right here, because if we just jump over to the futures tab before the market opens, I tend to just usually give some sort of a general idea for what I'm going to be looking for. We had the harsh sell-off last week, and then this was Friday, market sold off. However, during the overnight session, we ended up putting in a double bottom, and by the time the market opened, and before the market actually even opened, this was posted at 9 a.m. So we already had a double bottom, and the market was already over the points of control. So this was interesting that the market was able to put in some sort of recovery like this. I believe the catalyst pre-market had something to do with the tax news or something like that. I'm not a news-based trader, so we're not talking about that. We're just exclusively looking at technicals and setups. So this is already a key thing to look at. It shows that bulls were able to drive price back up over the point of control from the overnight session, and we were able to come back to the point of control from Friday. Let me actually just make this a little bit larger for you guys. Let's make this full screen. All right, so whenever I see this type of price action at the open, I'm not super excited here because I need to see some sort of confirmation that bulls are actually in control. So what I was just saying here is momentum traders are going to try and drive price higher, obviously, and this was the point of control from Thursday. So the SPY, or the S&P 500, what we're looking at is the ES futures. This is a 30-minute time frame, and these are volume profiles for each day. Now, if you're not a volume-based profile trader, don't worry about that. I just want to point you guys out for my thinking starts pre-market. So this is before the market opens. I'm coming up with some sort of a trade idea. I'm coming up with a plan based on what I've seen in the past. And as a trader, you want to build your playbook based around things you've seen happen many times before. So whenever double bottom puts in after a downtrend in the ES, I've already seen certain things happen time and time again. So I already know what to expect coming into the day. There's no way to know exactly what's going to happen. So that's why you want to draw up some sort of game plan. So in this particular case, whenever you see a double bottom, I like to wait for what's called a 50% retracement from that double bottom to see if the momentum will actually be strong for the day. So I was just saying I'm looking for a 50% retracement that holds to take a trade off of. So if this ended up being the 50% retracement and I see that bulls are actually in control, this becomes a place in which I will go long because I feel safe here. I know exactly what my risk would be, and then I would possibly be targeting this area or the pre-market high or the intraday high, wherever it ends up being. It depends on the circumstance. However, we do know if we have some sort of a 50% retracement after double bottom, if that area does not hold, what we end up getting is a 50% retracement intraday. So from here to here, if that level does not hold, then we get the next leg down, which would be the short trade. And this is what actually ended up happening today. So the thinking actually starts pre-market, and then as the market opens, the next thing I want to talk about is the VWAP, which would be, I use the 2-day anchored VWAP. So if we look intraday here, what we're looking at is the SPY here. Here goes the Qs, here goes the NASDAQ futures, and here goes the E-mini S&P 500 futures. So we have the futures towards the bottom, and we have the ETFs at the top, or the indexes at the top. This right here is a 2-day anchored VWAP. Again, if you do not have a 2-day anchored VWAP, do not worry. It's just an extra edge. In this particular case, I do use an algorithm, and these levels are not drawn in manually. This video is not about the algorithm that I use. If you are interested, the link is in the description down below. Full disclosure, I'm a main developer for the algorithm. The website is quanttradingapp.com, and I'm a quantitative developer, as well as I like to trade using quantitative methods. So again, you can disregard the 2-day anchored VWAP if you do not have this. What we're going to be talking about is VWAP, because everyone has VWAP. It's a free indicator no matter what platform you use, but just know I have an extra confluence of the 2-day anchored VWAP, and I also have these levels drawn in from an algorithm. But again, you guys can disregard that. However, what I did notice from pre-market, and this is something that I don't like to see, when the SPY is above the 2-day anchored VWAP, and what we have right here is the ES, right? So we're saying pretty much the S&P 500 is over the 2-day anchored VWAP. You can think of the 2-day anchored VWAP as the point of control from the previous day, but it's also accounting for any of the overnight session price and volume, and it's giving you a very strong average based again on volume. So if I see that the ES is above it, I like to look next at where is the NASDAQ, and I did not like that the NASDAQ is below it. You see right here, the NASDAQ is below it. I like to see when they're both above it or they're both below it, because it means they're in confluence with each other. This is always a red flag, and it means I'm not going to be looking to take trades as soon as the market opens in a bullish direction. I generally don't trade at the open for the most part, but that's one reason that keeps me out of losing money, I guess you can say. If you look at a gap up after a double bottom, everyone's very excited. It was a bad week last week. Everyone wants to jump in, and we're thinking we're going back here, and especially the way 2020 has been trading, every time we've had some sort of a pullback, we've just gone in to put in new all-time highs. Every time we've had a pullback, we've gone in and put in new all-time highs, and so forth. And that's kind of been the rhetoric for 2021. It's just been buy the dip. Everyone's just been repeating that. If you're watching this video in the future, you can already see last year, this was the pandemic, the 2020 crash, and the market has just rallied since then. So it's been very difficult to short. One of the things that keeps me out of getting into trouble at the open in terms of should I buy the open or should I look for bullish setups, it's usually the 2-day anchored VWAPs. So let's just make the SPY a little bit larger, and next we'll turn off the pre-market data. If you guys have watched any of my previous videos, you know I actually don't like to trade as the market has opened with the pre-market data on. And what we're talking about right here is this beautiful confluence area. Now, before price got to this area, we already established the fact that pre-market, we want to look for a 50% retracement on the futures. So let's start by drawing out our 50% retracement, and we'll actually see what we have here. So from the double bottom low right here to the market high right here, this would be the futures. This ended up being the 50% retracement. And then if you know anything about how I trade the Fibonacci, I use between the 50% retracement and the 61% retracement, because nothing is 100% and nothing is perfect. So you want to give it a little bit of wiggle room. So as I just draw this in here, I'm just going to lower the opacity so it's not super bright green. And what we have right here. So I generally will look at this as my buy zone for a retracement, because it's a defined risk, meaning if I buy in this area and price is below here and it closes below here, I know to close the trade because it means I'm wrong. Now, at 9 a.m. this morning, I was already prepared. This is one scenario in which I was thinking. I did not like the fact that VWAP was so far away from where price was at the open. It didn't seem like a high quality trade. This right here was what was, in my opinion, going to be the high quality trade. So if we go back to the Discord, what I mentioned, CPI numbers, let's just see if we scroll right here. So SPY is below it now. If we put in, so I was just mentioning again the same thing here. This was at the open. The Qs had already been rejected from the 2-day anchored VWAP, whereas the NASDAQ was still above it. And if it ended up breaking this level, it would be below it, just like the Qs. So just looking for the confluence. And then this was here we're seeing the 50% retracement, just walking everyone through it live, trying to help out the traders that were struggling over the past couple of weeks, because it was difficult to trade because the market momentum had shifted. It was no longer super bullish, and it's always difficult to trade when the market transitions from one environment to the next. But if you can be prepared for certain setups, and this is straight from my playbook, so I built out a playbook last year, so there's certain setups that I'm already aware of trading based on the market environment. So what we have right here is so the same time the SPY ended up retracing right to the algo level, that was the same time we had confluence with the 50% retracement on the ES. So again, just outlining that is just all the algos are pretty much programmed to do the same thing. So if you're buying a bounce trade on something like this, you're kind of trading what's called counter trend, because the market has been downtrending for a while. And if you take this trade as a bounce, you're kind of, again, trading against the trend. However, this right here, before price actually got to this level, I actually mentioned, if we scroll up here, it said this is the 50% retracement from the blah, 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 and I said, where do we have this here? We said if we put in, here we go. So at 9:41, we said the SPY is below it. Now I said, so if we put in a 50% retracement from today's high to today's low in this confluence of VWAP. That's your short setup to get puts, unless you're trading the downward momentum right now. So what do I mean by that? Again, at 9:40, let's jump to the charts again. And let's go to the SPY, maximize this for a second. And 9:40 would be right here. So I'm already talking about where do you enter your short. Now, momentum traders are trading this short here. If you're buying puts here, you're very late to the party and it's dangerous. You don't know where you're going to take your risk off of. However, this trade happens over and over and over and over and over again in the SPY. I cannot repeat how many times this happens, and this is why I'm making this video for you guys right now so you can be aware of this. If we draw out our fibs from the today's high to today's low, we end up getting right here our 50% retracement rejection. On top of that, do you guys see where VWAP is? I'm sorry if I didn't mention before, this gray line right here is VWAP on my charts. Again, this is free. Any platform in which you use, everybody has access to VWAP. And if you're not using VWAP and you're a day trader, you should definitely be look into it. Definitely learn to get educated on VWAP and why it's so powerful and why it's so important. But on top of that, we have for the quant trading app members, anyone that's using any type of proprietary indicator system or anything like that, you guys definitely want to look into the 2-day anchored VWAP. Again, the 2-day anchored VWAP is available to any member of quant trading app, but on platforms like TradingView, it's also available for free. I believe you can just click, there's an indicator button and you can just press the candlestick that you want to anchor VWAP from and it would draw it out on your chart. But to get it in Thinkorswim, it's not built into Thinkorswim by default. However, again, take a look at this. What we have right here is we have these two VWAPs lining up. So this is pretty much saying the point of control from the previous day is right here. Any algorithm, any programmer, any type of quant, any type of high frequency trader knows what the point of control is from the previous day. And that's why it's super important here. Again, if you don't have this, at least you have VWAP. This is essentially, you can read it. It's not a direct translation to what this means, but you can think of this as the point of control for the day. Again, do not quote me on saying that's exactly what VWAP is, but to simplify this video, you can think of it that way. So we have one confluence, two confluence, and then we have the 50% retracement. So what we have is the continuation of the downtrend. If we just clean everything, let me just hide all of the studies off the chart, and then we'll actually delete this right here so we can look at it very clean. What we have is continuation of this downtrend. Then we get this 50% retracement from here. Price bounces up here, and then we get the next leg down. So you're buying on this retracement, but it's not any retracement. It's a retracement. If you were to draw out a supply zone from the previous day, there's confluence in this area of, there might have been buyers in this area on Monday that are looking to get out because price gapped up. They were very excited. Then it broke down below what might have been their stop losses. They decided to hold. And now this is their chance. When price came back to wherever their average might have been from Friday, they're able to get out for a no loss or a break even, which is just human psychology. If you've held something all the way down here and you bought it here and you've been buying all here on the previous day, there was a ton of buyers here and there's a ton of buyers here, and you hold through all this pain, but then you tell yourself, I'm just going to hold till Monday because I think the market's going to gap up. Whatever your reasons are, the market actually does gap up. Then we have this sell-off. These are 5-minute candles, by the way. Then we have this sell-off for the first 15 minutes of the day. You're in denial. Your stop loss should be maybe below here, right? But you're in denial. Price comes down here. Then you get this chance. You get this one bounce. What do you think is the first thing you're likely to do if you bought here or you bought here on Friday? You held through all this pain. And then you held through this scary moment, because at this point, no one knew if the market was just going to go straight down again. There's a lot of fear kicking in here. This is the chance for anybody that bought here or bought here. And that's the psychology behind 50% retracements in these types of setups, to get out for a break even, to get out for a no loss. Just like most people, I'm pretty sure you would probably do the same. You would just close the trade here and just be done with this, because this is scary. Again, thinking the market is going to crash all the way down to about 440. 442, who knows how low we could have gone. So if we draw it out again, what do we have? We have 50% retracement. Hopefully I'm drilling this into your guys' heads so you can understand the importance of this right here. That's how you use the Fibonacci's. Look for confluence. If we turn back on our studies, we have VWAP and the 2-day anchored VWAP. And you guys know how I use the fibs. These are price targets for me. If we go to the low of day, first profit target. If we go to the negative 23% retracement, first profit target, and last profit target is the 61% retracement. So if we go back to Discord, I ended up posting this out here, and then it played out exactly as it should. We got the 50% retracement from today's high, blah, blah, blah. And this is exactly how it played out. So this is your entry to get short. Stop loss can be very tight right here. You get the next leg down, take profit here, and then we end up going a little bit lower, right? But then the next thing I ended up saying was, we have now it's 10:05, 20 minutes before price gets to the level, we can already anticipate price action because it's a playbook. If your scalper today was a week's worth of income, a break of the double bottom in the ES and panic should kick in. However, then we're saying, just encouraging everybody to take these screenshots, save this, because I have hundreds, if not thousands, of screenshots of setups like this, and that's why I'm so comfortable with it. So the 50% retracement for the shorts with VWAP plus the 2-day anchored VWAP is gold. And then we scroll, and here's what it looks like. Here's the setup, save it, remember it, and just wait for it for the next time. Again, sell off. So what we have is a gap up on a downtrend, and then price sells off at the open, comes back up, retraces, and we have this confluence right here of 2 VWAPs, and then we get this sell off, right? So then what naturally happens here? So it's crazy how blah, blah, blah. So then we didn't need to predict what was going to happen today. We just have a playbook of 2 to 3 different scenarios for what's likely to happen, and we play the card that matches what you see. So then now it's 10:27. Here's what I mentioned. It's what the algos are programmed to do. Now, if price retraces to the quant trading app zone, again, disregard this because I know not everyone's going to have this, but if price retraces to VWAP, there's another setup there, especially if it ends up being a 50% retracement. Why? Because that's the next low risk setup for any type of bears. However, if that short setup fails, that's where bulls will know to try and press the bears to reclaim VWAP, and if they do, the SPY should make it back to at least 447.90, if not higher day. So if we go back to the chart, what do we end up getting if we delete this right here? Let's hide our studies, and we draw out our next Fibonacci retracement. So from here, this was the previous high. Why do we use this? Because this is the new swing high on the intraday time frame. You see, this high didn't break this previous candle's high. This high did not break this previous candle's high. This high did not break this high. However, this candle right here, it broke this high, it broke this high. So this is what's called our swing high. That's why we use that as our anchor point. So if we go from our swing high, this is the new swing high. Just like before, this was the swing high, this was the swing low. Now we look for the new swing high, which would be right here, and we just trace it all the way down to the swing low. So again, 10:27. You guys see the time right here, 10:30, right? So right here in this area, I was saying the next short setup is the 50% retracement from this. If price gets back to this area and we have VWAP, if we turn back on our studies, what do we have? Again, price was here. I'm not predicting what's going to happen. I'm just saying what's most likely to happen. Where is a setup likely to form? Price gets here, we get this wick rejection, multiple wick rejections, 50% retracement. Again, this is our quant trading app level. We know what this means. A lot of the traders in here already know what setups we take off of this. It always ends up being in confluence. Before price gets to levels, we're most likely always prepared and ready to know what's going to happen in a certain area. But as you guys can see, we got to this level, and then what happens? We get the next leg down. If we head back to the Discord, continue to scroll down, here we go. This was the next setup. Again, 30 minutes before price gets rejected. Here's 11:30, so just the update. You could be prepared for it. Price made another 50% retracement with confluence. So if we look at it, so we had our first one went from here to here, and then we went down. The second one went from here to here, and then we went down. The key measure in this, guys, is VWAP. It's not any 50% retracement. On YouTube, I'm pretty sure a lot of you guys struggle. Anybody in which I've ever spoken to is confused with how to use the Fibonacci's and things like that. You want to look for direction of trend. Trend is down, so we want to look for retracements in the direction that the trend is moving, or retracements against the trend. So in other words, this 50% retracement is against the downtrend because we want to trade in the direction of the trend. Now the first 50% retracement In other words, if this came here and then price broke over here and it held, that's the setup in which I was talking about. And especially if we reclaim the 2-day anchored VWAP, we're more than likely to go higher, because that's when bulls would reclaim control. This is what the 80% or the 70%, 90%, no one knows exactly. The volume that's traded on the market, especially in the S&P 500, is done by algos. It's done by machines, high frequency traders. It's not done by people. And this is what these machines are programmed to do. And that's why these patterns and these setups continue to work. If I was going to program a machine, a bot that was just trading millions or billions of money, I'm going to program it to do something that I know every other machine is doing right now. And if you can spot these, you would be prepared. You'd be able to anticipate what the machines are likely to do before price gets there. And then you'll know if this setup did not work, you'll know to go long. You'll know exactly the area to go long, and your stop loss will be something below this. You can risk this much to potentially make this much. The same way by shorting here, you're risking, if it's over here, this is your stop loss, and you're getting 1 to 1, 2, potentially even 3. So you're risking 1 to make 3. In this particular case, every trade for today was a 3 to 1 in terms of a risk reward, and it was 100% accurate. From the bounce trade, if we jump back to the charts, make it nice and clean again for you guys, delete this, multiple trade setups. From pre-market, we said look for the 50% retracement if you wanted to take it long. Here was our 50% retracement on the futures. We got the bounce. This is a scalp. Take profit at VWAP. Then we have the 50% retracement. Short it here. Here goes the first trade. The next one, take the next 50% retracement. Take this short here. You get the next trade down. So that's 3 A+ setups, all conceived or preconceived before price even reached the levels. That's how you can come into the day well prepared, guys. And if we take a look at some of the options real quick, let's see how they perform. So this right here is the 447 put. So this is the 447 put right here. And what we have is right here at 950, this put was going for right here for about 68 cents. And right here from this move to here was worth 160%. This put increased in over $1 in premium. So you're talking about buying one of these for $68 and you're making over $110 or so in the matter of, what is this, from 1, 2, 3, 4, 5 minute candles. So, anywhere from 15 to 25 minutes or so you would have been in this trade. Very painless. You see, it works out pretty fast, and you're getting such an excellent entry that you're not really scared with this fluctuation here, because between here, if this is 70 cents and 60 cents, you're talking about 10 cents on the option. So for each contract you buy, you're risking $10. Or 10 cents on the option itself to potentially make over $1. That is an insane risk reward ratio. Now, if we look for the next setup, when price came to here, this is that area right here. This is the same time frame. As you guys can see, as I'm moving my mouse around, the cursors are matching. So at 1050, you have essentially 1, 2, 3, 4, 5. You have almost 25 minutes to decide, if you want to take this trade or not. How much are you going to risk? If you're getting a contract for $1, do you want to risk down to 75 cents? Do you want to risk to 60? Do you want to risk to 50? You have plenty of time to calculate, even though these are scalp setups, because price is stalling here for a bit and it's giving you some time. And then when you finally are in the trade, again, you're rewarded pretty quickly. These are 1 minute time frames on this side. So 1, 2, 3, 4, 5, 6, 7, about 8 minutes or so. You're getting straight down to the next target, which would have been low of day right here or Friday's close. And these are the contracts that expired today. Now what we're looking at here are the contracts that expire on Friday, just to play it a little bit safer if trading 0-day options is too risky for you, because it is a little bit dangerous. If you're wrong, you can lose money pretty quickly. So here are the contracts that expire on Friday, and what we're looking at is the 445 put. So just a little bit further out the money, because these contracts expire on Friday, which means they're a little bit more expensive, but they're a little bit safer to trade. So at this entry here, right when we had the signal to actually get short, which means we'd be buying these puts right here, you're talking about getting the put for $2 and call it 40 cents. So pretty much it's going to cost you $240 to get this contract. And from here to here, you're talking about an increase of over 50%. So for every contract you purchase, you're making $125 or so. And then right here, you're talking about getting the contract at the same time here, the same put. You're getting in at 285 and selling it at 365. So what type of increase in the option is that? So from here to here, at least a 25% increase or more in the contract. So you're making about $70, $80 per contract purchased. And these are safe trades again, because you enter in here, you can already see how it was not as violent here. Assuming you entered anywhere here, your stop loss can be below here. You're talking about risking, again, the same 10 cents on the option. So you're risking $10 to make potentially 70. Or if you trade strictly off of a 5-to-1 risk reward ratio, the moment, if you're risking 10 cents, the moment you're up 50 cents, you're taking profit. So hopefully this video helped, guys. And if you didn't understand certain things, just leave a questions down below in the comment section. I'll be happy to answer you guys. I'll try to make more videos based on these type of high probability strategies. I'm trying not to fluff the channel with too much nonsensical strategies that, you know, really only happen based on when the moon rises on the 2nd of every, you know, 4th June of the year. And, you know, there's a lot of crazy technical analysis when this crosses this, and there's just so much fluff out there that at the end of the day, this is just core logic and just core understanding what's going on. And I think that's what's really missing from a lot of traders' psyche. It's just understanding in the grand scheme what scenarios to look for. Here's our downtrend, guys, and we want to trade in the direction of that trend. We want to understand where are the traders being trapped, where are the bulls, where are the bears, where's the majority of them. We want to understand points of control, so that's why I started with the futures. These are some key things. This is how trading has been going on for decades, long before I've been a trader. Points of control, volume weighted average price, based on points of control, but understanding where retracements are likely to come and understanding how machines are programmed now to actually trade is quintessential. So if you're interested in joining the Discord, it is a premium membership. There is a public section in the Discord. If you guys do post any questions there, I will answer them. Right now, it's not very active in there. Most of the action is actually taking place in the gold membership, but understand the Discord is not necessarily about trading with me. It's more so about having access to quant trading app, and there's a lot the quant trading app has to offer, from the algorithm levels to the 2-day anchored VWAP, as well as historical price data, as well as showing you how to trade certain strategies. There's a ton of videos and things like that. So there's a lot more that comes with quant trading app. But again, you can just join the Discord for free, and you can always ask to see if you want a demo or anything like that. I'll be happy to show you around quant trading app so you can see what actually entails. But thanks for watching, guys. If you learned anything, share the video, hit the like button, and I'll catch you guys in the next one. Peace.